Hello guys and welcome again to my channel. So we're gonna talk about business combination, but before we do that, there are some background noises because we have our typhoon right here. So the outside is going crazy, but just don't focus on them. Just focus on me. Just focus on this. Okay. So business combination is actually one of the most difficult, as per interview with the students. This is one of the most difficult topic on advanced financial accounting and reporting. Well, I guess my job for today is not to tackle all the complexities, but we first start with the appreciation of the topic because all other complicated twists will just be easy if ever you appreciate the concept of business combination. Of course, we're gonna do some example here so that we will be able to illustrate that business combination is not actually memorizing complicated formulas or just memorizing formulas. It's actually logical. So, if we will appreciate that it is just logical, then maybe business combination will be easier. Okay? So, let's start. So, business combination. Let me write the topic. Business combination usually happens if ever there is a merger or consolidation of two companies. Okay? So, basically, the end point of business combination is the making of the consolidated financial statements. And I will illustrate that with this. So, merger and consolidation happens if ever one company or one corporation will tend to buy another corporation. Okay? So, for example, a certain corporation wanted to buy this corporation. It's because of a lot of reasons, like for example, competition. So, a established company has an emerging opponent or competitor in the market. So, if that established corporation or company wanted to monopolize the industry that they are in, he could buy the competitors or the company could buy its competitors. Okay? So what will happen is basically the buying corporation usually becomes the parent and the entities that were bought by that parent will become subsidiary. So there will be a parent subsidiary relationship. Okay? That's as easy as that. Okay? So, for example, let's have this. We have P company or the parent company and S company for the subsidiary company. Both are separate entities. Okay? Let's say for example, parent wanted to buy this. Again, let's make a a what do you call this? A sample situation whereby P wanted to expand or P wanted S to be out of the picture because actually S is a competitor. So using that, let's continue the example. So, parent company acquires 100% of S company. Of course, that will never happen if ever P company does not give anything to S company. So that's what we call consideration. So, what will P give up in order to get S? So the consideration, for example, 800,000. That's it for simplicity of discussion. So P company acquires S company for a consideration of 800,000. Okay? So, cold cash. So, what will happen to this 800,000? maybe this 800,000 will go directly to the shareholders, shareholders of S company, so that they will relinquish their ownership, and then the ownership will now belong to P. That's as easy as that. Okay? So, one of the things that you need to understand in order to appreciate business combination is the point of view method. So you have to know your point of view when talking about business combination. And for now, your point of view should be on the parent. Okay? So I have four steps. So again, our end point is to make the consolidated FS. Why? Because at the date of the acquisition, P company has separate financial statements. S company has separate financial statements. If this transaction of buying S will be successful, then P company should have its own FS, S company should have its own FS, but there is a third FS that is necessary at the date of acquisition, which is the consolidated FS. And that's what we're going to do now. Okay? Okay, now, there are four steps actually in order to make that happen. First off, you have to know the consideration first, because this consideration shall be recorded in P's separate books first. So meaning, if P paid 800,000, there will be an entry. So this is actually step one. I'll call this recording in separate books, book of the parent. So we have to record first in the books of the parent related to this acquisition transaction. Again, there are three books that we are expected to have at the end of this session. We have this parents company separate books, and S companies separate books, and the consolidated FS. Okay? So, recording in the separate books of the parent. So, what will happen? So, what will happen is the parent is to debit investment in subsidiary 800,000, and then credit cash 800,000 as the consideration. So let's extend the problem further. For example, the consideration is at 800,000 pesos. But guys, it's impossible to have a merger or consolidation without incurring costs, direct costs on acquisition. So let's put that direct cost is 50,000. So what is this 50,000? Direct acquisition costs are the costs incurred related to the merger or consolidation. Like for example, lawyers' fees or audit fees. Because basically, these financial statements, especially the S company's financial statements, which is the ones to be acquired, those financial statements must be fairly stated. So meaning, before these balances right here was finalized, it was audited, right? So my point is, there are direct acquisition costs. So some will be shouldered by P company. This is the 50,000, the P company's incurrence of direct acquisition costs. Okay? So that's 50,000. So what will happen? So you are not going to debit that one into investment in subsidiary. You're going to debit that one as an expense. And since P company doesn't have any income and expense accounts already, we are to assume that those income and expense accounts has already been closed to retained earnings. Okay? So what we will debit instead of expense is the retained earnings, 50,000. Because direct acquisition costs are expense. Okay? Now, step 1, since we have already recorded this in the separate books of the parent, then we have to, um, what do you call this? Post it in the ledger so that this will be effective, these journal entries. Right here in the P company financial statements that I have shown you, there is no account investment in subsidiary. So we have to establish that because we have some journal entries here. So basically, we have to effect these journal entries in the books of P company separately. Okay? So since we have debit investment in subsidiary, we have to debit right here. Investment in subsidiary. Yeah. And then we have to deduct 850,000 from the cash of 2.5. So minus 500, it's 2 million minus 3, oh no. Yeah, minus 300, that's 1.7. And minus 50, uh, 1,650. I don't know if I'm right, but this is supposed to be 1,650. Why? First, we have given up 800,000 to the owners of S company to relinquish their ownership, right? So from 2.5 minus 800,000, so 1.7. And then we have this direct acquisition cost of 50,000. So that means from 1.7, you still have to deduct another cash of 50,000. So 1,650,000. So what will happen now? This has been posted, this has been posted, and this has been posted to the books of P company separately. Now, this is the only ones that's left. So what are we gonna do? So retained earnings is 1 million right here. It will not become 1 million. It's only 950,000. So what will happen now? Of course, the total assets will be um, lowered by 50,000, and by 50,000 because even if we deducted 800,000 here for the consideration for the cash, we have established another asset, the investment in subsidiary. So basically, the ones that were deducted is only this 50,000 because it was not reflected as another asset, but instead it's an expense. So basically, without calculating, just analyzing, so we have 5,950,000 right here. But you can check that. You can solve this. 800,000 plus 1,650 plus 3.5, you have 5,950. And this also is 5,950. So that's the first step. Of course, the first step is very much logical. It's because again, in order to relinquish the ownership of the owners of S company, P company should give a consideration. Okay? How about step 2? So step 2 is actually computation of goodwill or net gain. Well, basically, we are still in the point of view of the parent or the acquirer. You can call it parent, you can call it acquirer, but we are on the purchaser side. Okay? The acquirer side. So, the computation of goodwill or net gain is very much necessary. It's because when you buy something, sometimes you are buying it for more than what it should be. Like for example, you're buying something at 2 million when in fact it could have been bought at 1.5. Why is it? Why did you pay in excess? So that's the question here. So actually the computation of goodwill, it will make sense. Um, the computation of goodwill is just like this. Consideration that were given up by the acquirer or the parent, you have to put it right here. So that's 800,000. You do not include the 50,000. The 50,000, the direct acquisition cost, is not actually a consideration given to the owners of S company. That is just a transactional cost. So you only put money or anything in the consideration if ever those were given to the owners of the acquiree, of the subsidiary, of the bot. Yeah. Okay? So, we only consider 800,000. So, this is as if the sacrifice of the P company in order to acquire ownership of S company. And you versus it with the fair value of net assets of the subsidiary. First, what is net asset? Net asset is actually the asset minus the liabilities of the company, of subsidiary. Okay? So the assets of the subsidiary minus the liabilities. And then we have to put this into account, fair value. Again, this is the buyer. This is the buyer. So this is the item sold. So you wanted to know, right? How much are you buying actually? Not in the books, but how much is it really? So that's fair value, right? So I'm assuming that you already know fair value. I'm assuming also that you're already good with shareholders equity topic, something like that, and you can relate already to what I'm talking about, even if I'm not explaining it. Okay? So, again, the net assets is actually the assets of the subsidiary minus the liabilities. But if you are going to put the fair value right here, that means you wanted to really know the value of the company that you are buying as the purchaser. Okay? As the parent, as the acquirer. You understand? So meaning, these non-cash assets in the books, um, we do not usually, if we are the acquirer, we do not usually believe in this amount. We wanted to have what is really the value of that in the market, the fair market value. Okay? So, if we are going to get the amount for this one, let's first start on the fair value of the assets. Of course, cash is at face value, so meaning its fair value is also the same with what is in the books normally. So, cash is 500,000. The non-cash asset is 1 million, but the fair value is 1.2. So we are going to consider this because this is the real value of what you are purchasing. So you have 1.7. Okay? The liability, since it's silent, let's copy the 900. Then we are going to get the fair value of the net assets of the subsidiary. How much is that? Minus 700, it's 1 million. Minus 200, it's 800,000. Yeah? Yeah, it's 800,000. So as you can see here, this is purely coincidence. There is no goodwill, there is no net gain. Because what you have sacrificed versus the ones that you have received is the same. So there is zero goodwill. Again, that's purely coincidental. I have not solved this beforehand. So let's revise a bit. Okay? What if this is just 1.1? Yeah. So this will become 1.6. And 1.6 minus 900 is only 700. Okay. So, what you have given up is 800,000 as the consideration. What you have received is only a subsidiary with a possible value of 700,000. So that means you paid excess. And that is what do we call as goodwill. Again, goodwill is an unidentifiable intangible asset. Okay? So, of course, as if we are not idiots that we bought only 700,000, we paid for 800. Actually, we consider the excess 100,000 as the goodwill of the subsidiary. Maybe that subsidiary has something that is unidentifiable, that is not reflected in the books. Because you already know that not all of the assets or liabilities or anything has been reflected in the books of the financial statements, because sometimes there are some assets that are not measurable, something like that. Like for example, S company has actually very good employees. Like all of them are cum laudes from universities that are very good, and they are very good on their craft. For example, of course, human resources will not be reflected in the financial statements of subsidiary, right? So basically, if you know that, you have to pay more. So let's let's have it at that. That's the example. There is something, there are some assets, there are some advantages that S company have, or assets that S company have, that were not disclosed in the financial statements, because there are some recognition criteria that must be followed in order to recognize assets here. And my example again is, what if the employees of S company are actually skilled, excellent, they have high academic background, something like that. It will not be reflected in S's financial statements, right? So it's as if that's the reason. So we have a goodwill of 100,000. And is that important? Yes, it's important for the step 3. Again, let me remind you, we are making consolidated FS at the end. Okay? So before we go to step 3, and you already know that this is very important on step 3, what if the opposite happens? What do you mean by opposite? The consideration is 800, the fair value of the net assets of the subsidiary, for example. This is just hypothetical. So 800. What if the fair value of the net assets of subsidiary is 1 million? So what will happen? It will become negative 200,000. Okay? So this is what do we call as net gain. Because it's actually net gain, right? You only paid 800,000 consideration, and you have received 1 million subsidiary. The subsidiary is as if valued at 1 million. So that's a net gain. So all are positives. In here, you do not consider the 100,000 as a loss, right? You're just stating that you have paid in excess. It's because there might be something about this company that you are buying, right? Of course, here, that's a net gain. No need to explain. Okay? So, those are the two, the computation of goodwill or net gain. But let's continue step 3. But we are going to use this first, the goodwill. Okay? So, step 3 is actually elimination entries, so that we will be able to make the consolidated FS. So what are these elimination entries? Remember, on the consolidated FS, the P and the S financial statements will be combined. They will be treated as one. Okay? So unlike here, that what we did in step 1, we separated P company, right? It's as if P company is still different from S company, which is why we considered these entries, investment in subsidiary and cash. Because if ever, our point of view right here, P and S is already one and the same, there should be no entries like this. Okay? Because there will be no credit cash on P's behalf if P and S are already combined. Right? You're just as if giving 800,000 to yourself. You understand? So, in here, P is separated with S, yet in this number 3, we have to eliminate with the point of view in mind, or with the idea in mind that P and S should be combined. Okay? So what will be the elimination entries? First off, you have to assume already the assets of S. Because again, you are the acquirer, S is already yours. So what will happen? You have to debit the assets of S, which is, for example, the cash, you have to own it as the parent. So you have to debit cash 500,000 because it's already yours. Okay? And then you have to record the non-cash assets of the subsidiary because it's already yours. And that is on 1.1, not the 1 million, which is in the books of S. You have to recognize the assets that you have acquired at its market value, at its real value. Okay, so you consider 1.1. And aside from that, there is a new asset. That's why I said the resultant for step 2 is necessary for step 3. You have goodwill, which is 100,000. I don't think that it's recording. I might be wasting time. Let me check. Ah, it's still recording. So, you have to debit the goodwill. And then, after that, we have 500,000 plus 1.1, 1.6, and we have 1.7. After which, you have also to assume the liabilities of S company because again, S company is yours. So the liabilities based on the problem is actually 900,000. That's already yours. Okay? So we have 1.7, we have 900,000. What's the other one? The investment in subsidiary. Again, in step 1, you have entered an investment of subsidiary in subsidiary of 800,000 because you are actually investing to the subsidiary 800,000. But since, again, we wanted to have consolidated FS where P and S are already one, there should be no account in the consolidated FS investment in subsidiary. Okay? Because again, P and S is already one. What is the subsidiary? Right? They're already one. So you have to eliminate the investment in subsidiary. And as you can see, you will know that you are correct if ever the debits are the same with the credits. And the balancing figure is the investment in subsidiary. That's 1.7. It's logical, right? And because of these elimination entries, you'll be able to draft the consolidated FS already. So, let's start. For example, if we talk about consolidated FS, we're going to still base on the P company, but we will effect these entries. Like for example, in there is an investment in subsidiary. In the Conso FS, investment in subsidiary will now become 0. Why? Because the 800 right there is accredited already in the elimination entry. So the investment in subsidiary is 0. Okay? How about the cash? The cash is 1,650 at the very beginning. But there is a debit here of cash. We have plus 500,000. So if that's the case, that's 2,150,000. Okay? And if that's the case, let's move on to the next. We have the non-cash assets. On the non-cash assets, the parent has 3.5 million. But since we already assumed the 1.1 of the subsidiary, we have to add that. That is also in the elimination entries. So 3,500,000 plus 1,100,000, that's 4,600,000. And of course, the goodwill. The goodwill that was computed is 100,000. So you can already get the total assets in the Conso FS to 150. I guess I need help. Yeah. To 150. Yeah. To 150 plus 46 plus 100, that's 6,850. The total assets is 6,850. Oh no. 6,850. Yeah. How about the liabilities? The liabilities, again, on the parent side, we have 2 million. But since we already assumed the liabilities of the subsidiary, we have to put the 900,000. And we have 2,900,000. How about the shareholders' equity? Actually, the shareholders' equity, this is the twist. As you can see, the assets and the liabilities are the combined amounts of the parent and the subsidiary, simply because the parent owns the subsidiary already. Alright? But when we talk about shareholders' equity, in this particular problem, we are not going to combine the shareholders' equity of P and S, because what will remain is the OSC of the parent only, which is 2 million. So not 2 million plus this 400,000. No, it's only the shareholders' equity of the parent. And we have OSC, share premium of the parent still. We have 1 million. And we have the retained earnings of the parent still. We have 950. Okay? So 6,850. Let's see if that is still 6,850 on the credit. Because on the debits or the assets, it's 6,850. Let's go here on the liabilities plus capital. So again, I might need help. So let's do this. 29. You can help me also. Ano, you cannot help me. You can check also if we are correct. So 2.9 plus 2 million, it's 4.9 plus 1 million plus 950. It's 6,850 also. Liabilities plus capital, 6,850 also. So that's how they do Conso FS in 4 simple steps. So again, you have to record in the separate books of the parent the consideration as well as the direct acquisition cost if ever. And then you have to compute the goodwill or net gain. And then you have to make elimination entries and you make Conso FS. But sometimes you can eliminate these elimination entries and go directly here after step 2. Why? Because as you can see, you are only combining the cash of the parent plus the fair value of cash of the subsidiary, the non-cash assets of the parent plus non-cash assets of the subsidiary. Fair value. I have to emphasize that. Fair value. Okay? And then, the goodwill that was completed here, that was computed here, rather, the liabilities are combined, and the shareholders equity of the parent you have to copy. So you can eliminate these elimination entries, but sometimes there are questions, what are elimination entries? So you still have to know this, okay? So this is the simplified version of making the Conso FS, okay? But since I know that you wanted to know what will happen if net gain, so what will happen if net gain, we have to revise the subsidiary FS if ever. It's basically the same, except that this negative 200,000, there will be no goodwill in the elimination entries. Okay? And the liabilities will be 900,000 and 800,000. The entry for the net gain is actually on retained earnings. So if this will be lost because there is net gain, there will be a credit here of 200,000 on the retained earnings. Okay? It will not be balanced, of course, because this is just a made-up example. Actually, the fair value of the net assets in our example is not 1 million. So, of course, this will not be balanced. But what I'm telling you is that if there is no goodwill, there will be no entry right here. There will be a retained earnings for the net gain. Okay? And if we're going to make a Conso FS, there will be no goodwill here. But there will be an addition to the retained earnings. So the retained earnings right here in our example is the retained earnings of the parent, right? But if there is a net gain in the computation on step 2, this 950 will be 950 plus 200,000. That will be reflected right here. So that's the only difference if ever it happens that our example is if our example has resulted to a net gain. Okay? The only ones that will be affected will be the elimination entries and the Conso FS. Instead of goodwill right here, what will happen is there will be an addition to the retained earnings account of the parent. Okay? Now, when you solve business combination topics, the questions might be what is the consolidated cash? How much is the investment in subsidiary in the Conso FS? Again, there is no investment in subsidiary account in the Conso FS because we are treating the parent and the subsidiary as one. And if you are going to be asked, for example, some tricky questions like how much is the goodwill in P company's books, the answer is zero because the goodwill or the net gain will only affect the Conso FS, something like that. So this could all be asked. And when you are solving also for business combination, sometimes the assets are not lumped into non-cash assets. They are spelled out into different types of assets like property, plant and equipment, inventories, and etc. Don't worry, the process is still the same. Okay? So that's it. No need to memorize a lot. And if you understand the logic of the steps, I guess other complexities of the topic will be bearable, will be understandable. And if you wanted to know more about twists like this, twists on the business combination, you can leave a comment because actually what we are doing right here is just 100% acquisition of subsidiary. There are also acquisitions like 70% only, all right? And there are a lot of things. Like for example, this is just on the date of the acquisition. How about on the subsequent years? Because on the subsequent years, actually, guys, you are also going to do this. From the parents' books and subsidiaries' books, you have to make a consolidated FS. So what will happen in the next or in the subsequent years? Especially if the parent and subsidiary has transactions to themselves. Like parent sells something to S and S sells something to P. What will happen to the consolidated FS? How do we do that? So that's what do we call intercompany transactions. And if you wanted to know more about those things, you can comment. We can tackle it together and make this very difficult topic easier. Okay, so this is me, Baby G. Please click like, subscribe, and hit the notification bell if you understood the topic. Thank you and see you on the next one.